Hello, everyone, and welcome to another edition of Under the Macroscope, Skybound Capital's weekly podcast. And today I'm going to be joined by Brendan Jack, a wealth advisor at RMS Advisory, which is part of the broader Skybound group. And prior to being a wealth manager, Brendan was an investment analyst covering shares and analyzing listed companies, both in South Africa and abroad. And today we're going to be discussing Chinese regulatory actions over the last few months with Brendan. And we're going to zone in on four specific things. The restriction of gaming for under 18s in China to weekends, private tutoring required to be not-for-profit, forcing the largest technology companies in China to open up their platforms to allow users to access links to other platforms. And here we could use an example of Tencent allowing users to access links from Alibaba's platform and vice versa. And then finally, forcing music platforms to not have exclusivity on artists' music. Now, these four things have led to some serious drop-off in share prices in Chinese technology companies. So, Brendan, starting with that, please just give us your thoughts on the above from an investment perspective.
Thanks, Matt. I think in times like this, it is important to take a step back for some wider perspective. So before I get into any investment specifics, I just want to touch on a few things. And one of the bigger things I'd like to kick off with is around one of the bigger narratives circling around at this point in time, which is the question, is the Chinese government and regulators looking to kill capitalism? Now, I don't believe so. If you look at what they've done with the recent spate of actions and interventions, there's a common thread there. Is to level the playing field for the benefit and advancement of the population as a whole. I mean, it's a very broad statement in itself, and the actions are very broad from the regulators and the government. So I'm cognizant of time, so I'm not going to climb into each one now. I'm going to focus in on tutoring for now. So in this context, if you look at it, there are 200 million people in China at this point in time who are estimated to be still living on less than $5 a day. And the estimates also that 3 in 4 children in China are part of families who have annual disposable income of less than $2,630 per annum. So if we look at what the Chinese party has come up with their recent strategic 5-year plan, one of the goals is common prosperity, and one of the other goals is also economic growth or continued economic growth. So to circle that off and say to the point of tutoring, is you can still see by the numbers that tutoring could still or has still been out of reach for a lot of or a fair amount of the Chinese population, which then circles back to the goal of common prosperity. They don't want to allow too much profiteering within tutoring to make it more affordable for the average person in China. So on this one, I'd like to refer or carry on with it, just to look at some charts using World Bank data. So one of the first charts, or the first chart, is the number of people in China who are, well, basically defined as living on the line of poverty, which is defined as $1.90 a day or less. So if you go back to 1990, there were 750 odd million people in China living on less than $1.90 a day. Roll that forward to just under 30 years later. This chart runs to just under 30 years later. There are less than 50 million people today in China who are living on less than $1.90. So you can see it's a massive improvement. That's a very big undertaking, just given the size of China's population. And the second chart I would also like to refer to is to look at the gross national income per capita. So simplistically, this is the total amount of money earned by a nation and its people, its businesses, basically divided by the number of people in that country. So if you look at this chart, the per capita income or the gross national income per capita, I should say, has increased from $300 per annum in 1990 to north of $8,300 just under 30 years later, which is an annualized rate of growth of 14% per annum. So to the point of, are they trying to kill capitalism? I don't think so. As you can see here, that the two are very closely linked. It's an inverse relationship. So the rise in gross national income has gone hand in hand with allowing capitalism and free markets to take hold more in China, and also then coming more into the world trade and trading more with the world with their entry into the World Trade Organization. So it goes hand in hand. Capitalism drives your gross national income, drives wealth, reduces poverty. So if you circle back to one of their 5-year goals of common prosperity and economic growth, you can't kill capitalism. It's as simple as that. So if anything, the goal of common prosperity is that they are not looking to kill capitalism. They are trying to manage and ensure that capitalism doesn't leave in its wake a huge divide between the haves and the have-nots.
Yeah, and one of the things that I take out of that as well is we often speak to our chief investment officer, Theodore Xu, sitting in the Hong Kong office of Skybound Capital, and the perception of what China does and what their regulators put in place is often misconstrued and misinterpreted, especially in so-called Western media. So it's always important to keep an eye on these things, and important that we do have feet on the ground. So how does this filter through to investments in China and related opportunities? Has this regulatory intervention, in your opinion, raised the risk of investment opportunity?
Yes, so it has introduced risk, but I mean, in investing, there is always risk. You can't get away from that. But I think one of the best ways to try and unpack this question is to use an example. So I'm going to use the example of Tencent Holdings. And they've been caught up in this recent spate of regulatory actions. And if you look at it, they are one of the biggest and well-known companies in China and globally. So that's why I'm also using them as an example. So I think it's important to touch on and talk around the Tencent example in terms of a couple of points. So the first point is, I just want to highlight that Tencent is not a one-trick pony. I mean, there's several business units and revenue streams within the Tencent group. So if we go and look at the financials, the most recent full-year financials for Tencent Holdings, which is for the 2020 financial year, the breakdown of group revenue, you'll have this look there, you'll see one of the top lines is value-added services at 55% of group revenue. Within there, that's where the online gaming sits. So if you strip out online gaming on a group basis, it's around 32% of total group revenue. So it's not like it's everything, unfortunately. So if we look outside of that in terms of what else does Tencent do, I think it's important to use another example of Wechat. And that is not just a traditional messaging app like WhatsApp, what people are familiar with. It's a platform of 1.25 billion users. Very, very big platform. And that user base has grown significantly over the last decade. So what does Wechat do? It's like a little ecosystem. You can order food, users can order food, taxis, do online shopping, social networking, similar to what we know as like Facebook and Instagram or what have you. And they can also do financial transactions all on this platform. So it's more powerful than just a messaging app. So they've basically integrated this Wechat into 1.25 billion people's lives daily. So it's ingrained in how people do what they do. And the second point is the recent regulatory actions, I don't think it's killed gaming. So if you look at it, these actions are targeted at under 18 specifically. But this is not the first time that the Chinese regulators have intervened to reduce the amount of time that under 18s spend gaming. So if we cast our minds back to 2017, 2018, the regulators in China stepped in at that point to reduce the number of hours that under 18s could play during the week on games. They also acted to bring a halt to approval of new game releases, and that lasted for quite a few months. But then if we look at what happened in that period of time, for context purposes, so if I go to the financial statements for Tencent for 2018 financial year, which was over this time, and we look at the breakdown in revenue there, Tencent still grew, this is Tencent Holdings, still grew group revenue by 32% year on year, despite these headwinds. And I mean, that is testament to not being a one-trick pony. And if you look within that growth number, gaming grew by 6% year on year. So despite those big interventions, gaming still grew. So I think key to understanding why gaming still grew at that point in time is to understand a bit more about gaming. So firstly, it's very well entrenched and is growing. And that's not just in China. That growth is global. As a side note to that, interestingly, China is the world's largest esports market. That's audience size as well as the tournament revenues. And the second point is that there's a large cohort of the population who are older than 18 years old, who are gamers. And these people are typically, people who are employed. They've got disposable income and they spend some of that on games. So that is why I don't believe that gaming is dead. It just can potentially slow the growth rates down for a period of time. And then the third point to keep in mind is at this time now, after the share price of, say, Tencent and similar tech companies in China have come off by 30-40%, the valuations are on investors' side now, following these sell-offs. So, I mean, we know as in, life, you can't control things. There will always be uncertainty, there will always be risk. But in investing terms, how do you manage that risk? And the key ingredient to that is investing when there's not a lot of blue sky possibility in the share price, which is the proverbial margin of safety that go around in investment circles and people will hear. So I'm going to refer to another chart now, which is from Bloomberg. And this chart spans from the time that they listed in 2004 to now, to date. And on this chart, we've got 3 lines, all representing the share price relative to a fundamental. And this chart, we've got a price to earnings, share price relative to earnings over that period from 2004 to now. That is represented by the white line. We've got the share price relative to actual cash flows from 2004 to now. And then we've got the share price relative to the revenues, all on a per share basis, all of these metrics. Also, again, 2004 to now. So if you look at where these valuation metrics sit, the price to earnings and the price to cash flow is around 20 times, which means that at this point in time, you're paying around 20 Hong Kong dollars for $1 of earnings and or cash flow. And if you look at it over since the time of listing, it has only been this cheap twice before, since listing in 2004. So there is that margin of safety in that. Because if you look at it, let's just run a scenario saying, well, what happens if gaming revenue does not grow for the next few years? Just as a what if. Just looking at where the valuations sit, how sort of cheap these things have become. Is it likely that the share price will fall another 30-40% from here? It's not likely under that scenario.
So, Brendan, listening to that and looking at that data, and also just making it very clear that this is not an advisory podcast. We're looking at some macro issues here, but they are fascinating. But on the face of it, it would appear that you believe it's probably oversold, that these recent drops in prices of technology companies, not only Tencent, have been more dramatic than perhaps they needed to be, given the macro fundamentals. So if it was me, is this a sector and perhaps even a specific stock that I should be looking to get into at these prices?
Well, I'm not trying to tout only Tencent. So the answer is no. I think the key point is that people need to seek financial advice before they undertake any investments. I mean, share investing in the stock market isn't for everyone. There are risks involved. And there's also a very wider range of companies listed and investment funds which focus on stock markets out there. So who do you choose? And that's why it's important to obtain advice. But what I am trying to highlight via the example of Tencent is that when the press headlines present a certain narrative, that often that presents opportunities, but you need to do your homework and you need to get independent financial advice to take advantage of these opportunities to manage the risks.
Yeah, and it certainly means that there's often more detail behind some of those headlines. So some really good deep dive research is really the key. Brendan, some fascinating insights there, and these are topics that our Chief Investment Officer Theo has spoken about regularly internally within the business. And I believe he shares similar views that the response to some of these regulatory interventions has been more radical and perhaps driven more by perception than reality. So it's going to be a space that we need to keep a very close eye on. So thank you for your time on Under the Macroscope, your first appearance. The podcast can be downloaded on Apple, Spotify, and the Google podcast platform for Android. And all past editions of Under the Macroscope are available at Skybound Capital's website, www.skyboundcapital.com. Until next time on Under the Macroscope, have a great week.